Barchart series of educational webinars designed to enlighten you of a variety of investment and trading ideas. Today's session, Power of the Squeeze, John Carter's volatility indicator revealed. Now, John Carter's squeeze indicator is a unique approach to identifying periods of low volatility and that anticipated explosive price movement, which Carter calls high probability moments in time. Now, armed with this tool, traders simply wait through identifiable periods of consolidation and react to the easy to recognize signal when lucrative breakouts are about to occur. Hello, everyone. My name is John Rowland, Barchart Senior Market Strategist. In today's session, we're going to look at the principles, components, and the practical applications of the squeeze, as well as explore Barchart's investment page, the TTM squeeze, and the associated chart templates designed to complement Carter's squeeze. So stick around as I try to compress as much technical analysis knowledge in today's session to help you squeeze out profits from understanding how to effectively utilize volatility. Now, before we get started, please welcome our moderator and Barchart's project director, Jean Baker. Hello, Jean.
Happy Wednesday, John. How are you doing?
Hey, I'm doing great. Yourself?
I'm doing great too. Yeah.
I know before we came on, we were both lamenting a little bit that winter, it seems like it's knocking on the door, doesn't it?
Yeah. Well, back in Chicago it is, yes. Not sure about by you, but it's around the corner.
It's been cold. Yeah, it was cold last night, but
yeah.
We didn't get snow like you did.
No, you did not.
Okay, Gene, you want ready to get started then?
Yes, let's get going.
Just to remind you that today's session is for educational purposes only, and trading or holding or in securities or commodities or any other investments involves risk and are best made on the advice of a qualified financial professional. And under no circumstances shall we be liable for any damages or losses that you incur based on any information or material that you receive through Barchart.com and our services. And I would also add that this presentation is my interpretation of John Carter's squeeze. Okay. So the squeeze indicator, right? So John Carter is a renowned trader and author and has made a lot of contributions to the field of technical analysis with innovative trading strategies and indicators. And the one that is most notable from his book, Mastering the Trade, is this volatility indicator called the squeeze. Now, the indicator is designed to identify periods of low volatility and this anticipated potential explosive price movements in financial markets. Now, the concept behind the squeeze is that it helps trader identify these low periods of volatility, which often precede high volatility breakouts. And this assists the trader in taking advantage and capturing these potential explosive price moves and shifts in momentum. Now, markets alternate from low to high volatility periods. So when the market is in a low volatility or is consolidating, it's very similar to a coiled spring. It's building up pressure or it's squeezing price. Now, what the squeeze does is it helps us to identify this move from low volatility to high volatility. That's the ideal of the squeeze. Now, the reality of markets, though, is that about 3/4 of the time, markets are in what we would call consolidation or a range bound or even trendless. And only about 1/4 of the time are we trending or what I call volatility impulses. So this is what the squeeze is going to help us identify. Now, when the indicator fires, This confirms that volatility is increasing and that prices are likely to break out of their tight trading range in one direction or another. In other words, the fire is the signal, and this gives us permission to take action or put on a position. Now, the components of the squeeze, one of them could be contributed to the idea of the naming of this indicator, and that would be Bollinger Bands. And Bollinger Bands are a measure of volatility that consists of an upper and lower band, of a standard deviation, and a middle band based on a moving average. Now we're going to eliminate the middle band and in my demonstration later. And then what we're looking for is when the bandwidth of the Bollingers gets squeezed inside of the Keltner channels or Keltner bands. And this is a time of low volatility. Now, Keltner channels or Keltner bands are similar to Bollingers, but they're based on an average true range. And they give us an upper and lower channel, which is a multiple of ATR to current price. And then there's a momentum oscillator histogram, similar to a MACD, a moving average convergence divergence. You might be familiar with that. And there's two purposes to this histogram. First, it's going to confirm the direction of the potential breakout. And second, it's going to help us identify velocity and momentum of price movements after the firing as the squeezes energy is released onto the price. Now, using the squeeze indicator, we're going to use a very systematic approach. But before we get to that, what I want to do here is I want to give you a better understanding of the squeeze based on a visualization. And so what I've done here is I've created a template that has the components of the TTM squeeze, and it mimics the squeeze. Now, it's not exactly the same, but I think this will help you understand what is going on with the squeeze. So the two red lines here represent Bollinger Bands, and Bollinger Bands in this one is set up based on a 2 standard deviation over a 20 period look back. And the purple lines represent the Keltner bands or the Keltner channels. And they represent a 1.5, the ATR, average true range, over the same 20 period look back. Now, as both Bollinger bands get squeezed inside of the Keltner bands, this indicates that our underlying asset is in a state of lowest volatility. Notice that our MACD, which I'm using here down below, is confirming this, right? We have a flat MACD and we really have little or no histograms. And this is confirming that we are in a trendless market. Now, what I'm going to do here is I'm going to draw a vertical line at approximately, it looks like it's right about here, where our two Bollinger Bands go inside of our Keltner bands. Now, this is what is called the squeeze is on, or the triggering, the beginning of that coiling of energy. Now, a trader needs only to wait for one of the Bollinger Bands to break outside of the Keltner bands to fire the squeeze. And this is our sign of that releasing of that energy and the returning of volatility. So again, let's draw another line, and we can see that about looks like this candle right here would be where those Bollinger Bands are breaking out of our Keltner bands. I'm just going to see. Yeah, I think it's about there. So I know looking at this, it could be a little bit confusing or difficult to interpretate, but what is nice is that Carter has created a template which Barchart has adopted. And this is going to be a lot more easier for us to read and react. So up here in the right-hand corner where it says templates, under here where it said my templates, we're going to open that up and we're going to go to bar chart templates. And this is where you're going to find some predetermined or preset templates that will help you in your trading. And there you see right at the top is the TTM squeeze. So let's turn that on and apply it. And bingo, what do we get? Well, we get a candlestick chart with 3 EMAs, exponential moving averages, and we get the 34, the 21, and the 28. Now the EMAs are going to help us in determining the potential price movement, but we're basically going to use them as a risk control measure, and we'll look at that in a moment. And then we get a histogram, which offers us 2 pieces of information. Foremost, these red and green dots. Now remember our vertical line that we drew where we identified where the Bollinger Band came inside of the Keltner Band? Well, that was the trigger. The squeeze was on. Notice how our dots go from green to red. And the red dot is created by the conditions of the squeeze, the setup before the release. So the first red dot is the setup. Now that will be followed eventually by a green dot, which is the firing. So the red dot can be just one, or it could be several dots, but there is only one fire per squeeze, and that is the first green dot after the red dots. Now the histogram also tells us what type of position we're going to take. Above the 0 line or blue bars, we're going to take a long or a bullish trade. Below the 0 line, or pink, or these look like pink or purple lines, we're going to take a short or bearish trade. So in this one, we're looking at a bullish trade. Now, Carter also adds confirming the decisions by looking at your EMAs. And he wants to see something called stacked. Well, in other words, what he wants to see is that the shorter EMA, the 8, is above the 21, and the 21 is above the 34, and price is above all of them for a bullish signal. Obviously, if we're talking about a bearish signal, it would be in reverse. So you can see that as well. Our EMAs are pointing up at the firing, and we have the intermediate above the longer and the shorter above the intermediate. And our histogram, you can see, is blue bars, which is telling us this will be a bullish signal. So I did a scan from our TTM squeeze page, and I want to kind of show you another example. Again, here we can see a red dot, then a firing, our blue bar, and again, you can see our stacked EMAs. Now, Carter also says that any divergence from this systematic approach, for instance, if we have inverted EMAs, the long is above the short, or we have a reversal in the histogram and price action, they are in conflict of each other, or we see no visible price movement or momentum through the histogram. This could create a false or effective signal. So here is Disney, and there is a squeeze. There it is, squeezes on red dots, and then there's the firing. So the firing here gives us a blue bar, which tells us we want to take a bullish position. But are we having divergence? And we are, because what we see here is that our short-term moving average is below our intermediate, and our intermediate is below our longer term. In other words, inverted to the signal. So this would be an ineffective, excuse me, bull signal. And you can see again, you'll notice how quickly the release of energy wanes and the market ends up going backwards or back down. All right. So let's go back to, here's our lift, and I'm going to change this back to my components. And again, notice that the squeeze was on, right? And then we got that firing, that confirmation with our MACD, that positive price momentum, or that permission to take a long trade. Okay, so using the squeeze, right? This systematic approach, right? So we're going to identify the squeeze, the red dots, right? The red dots. And then we're going to wait patiently for the firing. The firing confirms price movement and the return of volatility. Well, we're going to confirm that by looking at the histogram and seeing those EMAs stacking in the direction of the histogram, and then taking a position. Once the squeeze has fired, we're going to confirm all of this information, and then we're going to take the position in the direction of the histogram. Again, above the zero line, we'll enter into a bullish position, and below, we're going to enter a bearish position. Now, this is where it starts to get interesting, especially if you're a Barchart subscriber. And that is because if you go into investing and under technical ideas, you're going to find the TTM squeeze. And this is going to give you 3 stages of the squeeze. First, the triggering that squeezes on the red dots, and 2 firings, that first green dot. A bullish squeeze or a long squeeze is where price movement is up and our histogram is above the zero line, or a short squeeze, which is bearish and price movement is down and the histogram is below zero. Now, why did I say this is important to be a Barchart member? Is because, or subscriber, is because if I go here, I can screen on this and I can add additional filters. Now we'll look at adding some additional filters. We'll look at something like options or something as simple as a new monthly high or a new monthly low. But once I get those results, depending on what fundamental information or technical information I want to screen on, in addition to the TTM squeeze, is I could save this screener. I could name it. And then if I'm a premium member, I can actually have that screener sent to me every day. So it's going Barchart is going to do that work for you, which is a nice tool. All right. So let's go back to a couple of our examples here. And I'm going to go back to our template, or chart template, TTM squeeze. And so sometimes, or when we're starting to look at TTM squeezes, Again, the signals we're going to get, we might not take. For instance, a 1-dot trigger. Well, here's a 1-dot, right? And 1-dot might not be enough time for the energy to coil, especially if my EMAs, in this case, you can see we have inverted EMAs. And what is our price action, right? Look at our histogram here. It does give us a little bit of a bearish indication, but not very significant above or below our histogram. So we might need to wait a period or two and see if we get that positive reaction and the related bars to our histogram. Notice how this one actually would do a sell signal and ended up reversing and turning the other way. Again, does a 1-dot trigger allow that coiling to happen? It could, but I think what we want to do is stay away from examples like this. Again, here is looking for better examples like this, where we might wait for a second or third day to confirm. But again, is this enough energy to be reflective in an explosive move? And you can see that this price movement, yeah, it was a bit of a movement, but maybe not a big explosive movement. As we can see here, we had multiple days of the squeeze, right? Really tightening the market. You can see it here. And now we're getting that firing, and we're seeing a very explosive type of movement. So again, what we probably want to do is wait for a cluster of red dots, patience, wait for that firing, look for those conformational stacked EMAs and positive or negative bars in our histogram, waiting for that squeeze of multiple dots, stacked EMAs, and price action that is confirmed by our histogram. Okay. Let me do something here for a second. Give me a second here, folks. Okay. Okay. All right. So managing risk, all right. Well, we're going to look at how we're going to manage risk using the squeeze. Now, with any trading system, it's crucial for you to have some type of risk management technique. And considering setting stop losses in order to protect us against adverse price movements, and also learning how to set trailing stops to help us to secure profits. Now, in his book, Carter does offer several different risk management techniques, and we're going to look at a couple of them. But he does admit that he likes to jump the gun by using intraday time frames like 1 hour in 2 hours, but suggests a case for using a higher time frame like a weekly to give you guidance or help you define your risk in lower time frames and setting up those lower time frame trade plans. In other words, give it context. Now, you might think a weekly time frame is too long to design an intraday trade, but Carter and myself believe that paying attention to weekly squeezes and if they're firing is a complementary enhancement to risk management. And what we don't want to do is take smaller time frame squeezes that fight or are against the weekly squeeze or histogram. All right. All right, so this is a good example. So here is ConocoPhillips, right? And But besides the obvious here, so here's our squeezes on, and we get a firing, and we do see our blue bar here. And again, this is a small blue bar, but it is a positive bullish firing, and we do see price action is moving in a bullish direction. But again, notice how our EMAs here are stacked against us, right? Inverted, right? That again would be a sign of maybe more ineffective signal. But let's change our time frame from daily to weekly. And what do we see here? Well, we see that we've been in a weekly squeeze on for looks like almost 2 months, right? A sideways directionless market, and we're getting a firing today. And that firing, or this firing for this week, is negative or a bearish signal. So our weekly is in contradiction to our daily, which is another sign for us to bypass and not take that trade. Now, if we go back to lift and I go to a daily to a weekly, now notice that there is no squeeze or firing at the moment, but what do we see based on her histogram here is we see a supportive histogram, a bullish histogram will allow us to take bullish trades at the daily or intraday level. All right, so let's talk about entries and that initial risk we're going to take when we put one of these trades on. So that could be measured by the high or low bar that fired, right? That created the green dot. And we're going to set our stop opposite of the direction of the trade. Again, let's look at our example of our lift example. So here is the firing, the candle that fires. So we could set a stop below the low of this candle. And that would tell us if price went below there, well, then maybe this firing is not working. But if I have a way to define my risk or my risk tolerance, a very good tool could be our EMAs. And I could set up, if I'm willing to take that risk, I could set up my stop outside of the 34 EMA, the lowest one. Now, again, if this was a short, this example would be in reverse. Well, this is where we could set that initial stop placement. All right, so the squeeze itself, when it happens, when it fires, that the price movement after a squeeze firing tends to last for about 8 to 10 bars. And when the histogram starts to move back towards the zero line, consider exiting the trade. All right, so here's MGM. And there's two ways we can, let's change this back to a daily. There's two ways that we can do this. So first of all, here's our squeeze, and then there's our firing. And again, a good squeeze is going to last, in that 7 to 10 days. So 1, 2, 3, 4, 5, 6, 7 days. So here we are at peak bar, right? Peak momentum, peak histogram. So what Carter says is that if the next bar starts to move towards the zero line, that you might want to think about exiting a trade. Now, a nuance that I use is that I will look at the bar previous to the peak bar. And if the bars that start to decrease in size falls below that bar, then to me that is a sign that we have a waning momentum, and that could be an opportunity to exit that trade. Now notice if we do that, same idea here, where we have the previous bar before the peaking, then that wouldn't happen until we got to this bar before we would have exited. Now, the other thing you can do is we talked about using the EMAs as a tool for us in risk management. So again, let's go back to this example. Here we can see this bar is below our previous bar and our peak bar. And if we go up to the candle here, you can see that this green candle closed inside of our 8 EMA. Again, a signal to us that there is probably a little bit of a change in momentum, and that might be a good opportunity for us to exit that trade. Again, if I'm going to use the EMA in concert with my histograms, notice that even this one that is lower than my previous peak bar, we did not close inside of the histogram, and that we would wait for that to happen, which would have been on this one. And again, this is just a different type of risk management. I just want to show you a lot of different ways that you can do that. Now, Carter also believes in using a 2 times ATR, the 14 period ATR. So let's go back to our lift example and where we currently are trading. So if you're not familiar with where you can find ATR or understand the idea that we have a lot of great webinars on ATR. One of the ones that I'm really proud of is look for the one that says ATR, the Swiss Army knife technical analysis. But if you go under technical analysis and you see that we do give you the 14 period ATR, and that is $1.10. So let's go back to our chart. So here is current price, and if we take the high price here, this is called the chandelier method. So here we have the high price of $25.54. And then Carter says, well, we're going to use a stop that is going to be 2 times the 14 ATR. Well, that would be $2.20. So we would subtract $2.20 from this, and that would give us around 23.34, which would be somewhere around here. Now, again, you could blend risk management based on an ATR assessment and our EMA. Now, if we use, say, the closing price, now we don't have a closing price just of yet, but again, we'll look at, let's say, assume we're using $24.46 and $2.20. That would put us below the 8 EMA. So again, 2 different types of strategies for risk management, and you can see that they kind of fall in the same level. All right, so that's a way we can use trailing stops with either using our EMAs or this ATR assessment. So, okay, so now we have an understanding that there's changes in volatility and that some of these changes can be short-lived, right? The squeeze is really looking for 8 to 10 periods. And if we're looking at dailies, that's about 2 weeks. So playing the squeeze to its optimal performance, this 2-week period, and if we're using dailies, then to maximize our payouts or our potential payouts, then using options leverage is a more effective strategy choice. And Carter advocates 3 possible option strategies that you could use with the squeeze. The first being that buying in the money calls with a 70 delta. Again, this is a bullish scenario. Now, why do we do this? Well, first of all, there is the leverage aspect. We can control a lot more of stock using options than we can than buying the stock outright. And we're going to get a much greater risk reward when we get price action to move us. Now, why 70? The 70 delta. Well, delta is a representation of how much the option is going to change with every dollar price movement of our equity. So if I have a 70 delta and my stock moves $5 in my favor, then my option is going to move at least $3.50. And why we don't buy out of the money calls, which is say have low deltas of 20, again, in that same scenario, if I have a $5 movement in an option, in the stock, then the option of a 20 delta is only giving me a reward of about $1. But again, knowing where I'm taking a high delta strike, high delta strike, there's applications in risk management. In other words, if I know that my delta is, let's say, 70, and I'm $2 away from my EMA, $2 times 70, or $1.40, knows that how much my option is going to lose if that price movement does move. And again, I can use that to help me assessing risk management, risk to reward, and how much maybe I'm willing to give back. Now, Carter and myself also believe that I'm going to do an option that is a little bit longer dated, somewhere in that intermediate time frame, somewhere between, let's say, 30 and 60 days to expiration. This is going to help mediate the theta decay, the decay that all options undertake. So let's go to lift here. And I kind of just want to remind you where we were at. So at the time of the squeeze, right, and the breakout, right, we're somewhere between $20 and $22, right? So let's look at the long call. And I'm going to go to at least 30 days out, which I think is the December monthly. It gives us 37 days out. And, you know, we're probably want to be inside of $22. So here's like the 21 and the 20 call. So let's just use the 21. We can go over here to the right, and here's price history. And this squeeze firing happened about 3 days ago. And you can see that the $21 call, which at that time, 3 days ago, had a delta of 78, and opened up around $2.50. It got as low as $2.25, but by the end of the day, it finished $3.36. Now, this is why we use options, because you can see that for today, lift is up only 1.2%, but the option, the $21 call, is up 10% over price yesterday. So that's the leverage of options. All right, the other scenario that Carter likes to use is to sell out of the money puts below the EMA in bullish markets, or help me out here, there we go, or sell out of the money calls above the EMA in bearish markets. Again, if I was going to look at this scenario, here's our EMA at the day of the firing, again, right around $20. Again, I could look at selling naked puts below the $20 mark. Now, if you're going to do these types of credit spreads, you want to be short dated. In other words, knowing that the squeeze is going to only happen for about 8 to 10 days, we probably want to be 2 weeks to our DTE, or days to expiration. And if I want to limit my risk, for instance, not selling a naked put, I could do something called a vertical spread. And the ones that would be looking at again for another strategy could be looking at those, for instance, those bull put spreads or bear call spreads. And so in this case, we could look at the bull put spread. And if I don't see a good combination, I could just show all. And again, let's go in out, let's say about 2 weeks. What is that, about 16 days? And I could look for, let's say that, change that and look for that 2023 would probably be a good one. And then the third option would be buying an at-the-money call or put and doing some type of debit spread, which would be bull calls and bear puts. And again, in this scenario, we'll probably want to start looking at a longer dated one. Again, you know, we know it's only 16 days, or excuse me, this one's 16 days. But again, if I go out to, let's say, 37 days where I don't have that theta decay or less of that theta decay, start looking at some of the net deltas in this scenario where you could see the net delta is somewhere around 30. I kind of look in that 25 to 35 net delta. And if I scroll this down here, you know, you can see where we're trying to look for something that is at the money. And so here would be a 24.28 with a net delta of around 33. It's going to cost me about $1.40 to get into this trade, and the potential reward in this one is $2.50. Now I kind of look for what is a 1-to-2 ratio in the maximum loss to maximum profit. And so that's just kind of right in that range. So that would make for a good bull debit call spread. Okay. So let's do this, Gene. I'm looking at the questions. I see you've answered a lot of them, right? I don't see any on the board right now. How are we doing on questions?
I think we're caught up. Unless anybody has a question for John, just go ahead and send it through the chat. I'm going to take a moment here, John, just to remind everybody that in order to screen on the TTM squeeze reports, and in order to add those kind of filters to your screener, it does require a Barchart Plus or Premier membership. If you're not one of those members already, we offer a free 30-day trial, so I highly suggest that you take us up on that offer. You will be able to use the Barchart template, the TTM squeeze template that John demoed for you earlier, though, as long as you have a free Barchart account. So screening is a great opportunity to find additional candidates, as John has been showing you here.
Yeah, so let's do that, Gene. Let's do a little screening. And this is really kind of where the power of Barchart and the TTM squeeze comes together. So for instance, you know, I have a lot of watch lists. And here's one is on data centers and powers and parts. And this is all about that AI play, right? So here's my watch list, right? And so what I'm going to do is I'm going to come in here and I'm going to screen on my watch list. There it is, data centers. And the first thing I'm going to add is I'm going to go down to technical analysis, open this up, and I'm going to scroll all the way down to the bottom where it says other. And there's the TTM squeeze. Now I'm going to add that in. Now notice I can use looking for when the squeeze is on. I can look for longs, or I can look for shorts. Well, we're going to leave this unchecked box for the moment. All right. The next thing I'm going to do is, you know, we talked about using the options. Now, unfortunately, not every stock has options, and some do have options, but they don't have a lot of volume, and so they're very difficult for us to either get into, or more likely, if they have low volume and low open interest, are difficult for us to get out of. So we're going to first look at it. Does the stock have options? And the second thing we're going to say is we're just going to give a threshold, a very small threshold for stocks, and say, let's say it's a daily volume monthly average, at least 1,000 options. And using this threshold, you'll see that you can whittle out a lot of potential candidates. Now you can see that here's the options volume, and probably the ones that are in the 20 to 46 will probably be other options candidates. But notice that our squeeze, a 0 means no indication, but here we have 3 contracts right now where the squeeze is on: GE Veranova, Quantum Services, and TTSI. So let's again go to our flip charts. Here's GE Veranova. Here is our grid. Let's go to our TTM squeeze. And right, again, looks like we've had about a 2-day squeeze here. We are seeing our EMAs are stacked to the negative. So if I get a positive firing, I really want to see these get back above the 34. If we get a negative firing, that would be more conducive to the conditions that we're currently seeing. Here's Quanta. Again, nice squeeze here, beautiful squeeze in a already productive setup, stacked, right? Again, probably going to look for, a price action above. And I bet you if we go to our weekly, we're probably not going to see a firing here, but we're probably going to see a supportive histogram. So again, probably waiting for that one. All right. So here's another way to do this. And this is really what's kind of cool is here I'm going to do is I did the same thing. I'm going to do a screener, but this screener I started from my watch list was literally the S&P 500, all the stocks in the S&P 500. But what I'm going to do here is I'm going to trigger for longs today. There's my options. There's my options qualifier. And then I'm going to add what is called the new high date. And I'm saying is show me all those that are triggering today that has made a new monthly high. And this is what an old school technical analysis of looking for markets that are making new monthly highs, new 4-week highs, or new 4-week lows. That is usually a sign that you have some good, strong momentum. So I want to see a new monthly high within the last 2 trading sessions. And remember, we're talking about 500 stocks here on one system. And that gives us 9 candidates. And I think that you could go through here and look at a lot of these candidates. And notice, look at some of them we already looked at. Disney and Morgan Stanley, I think we already looked at them. BK was another one I think we looked at. So again, come back to our flip charts, go up to our template, get our bar chart TTM squeeze out, and look for those ones that seem to be in the right context that we want. Here's TJX, I think was another one that looked very positive to me as well. Again, notice nice histograms, nice stacked EMAs. And again, I think if we looked at this from a weekly, I don't know, let's see, what do we get? A very supportive histogram. Okay. Right, before we get to some takeaways, I do see some questions. Gene, you stirred some up, so let me take a moment here. Does it work for ETFs and their options such as SPY? Yes, it does work. Just understand that when you talk about an ETF, right, you have so many different stocks that are in an ETF, so you're not going to get the same results. You might actually not get as many signals as well. So keep that in mind. But Carter uses it in futures, and I use it in futures. So Ted, you might want to try that. William asks, for a beginner, would you recommend reading the book? I would say you don't even need to be a beginner. I read the book, matter of fact, going back 2 sessions this is my third time I've done a session on this one. Going back 2 sessions, I've heard of it, I knew of it, but I didn't understand it. So I did buy the book and I did read it, and I found it very intriguing. So William, yeah, I would definitely recommend you read that one. The squeeze triggering bear bull on the screen, or how do you interpret them? So again, I think when we talk about the screener itself, the TTM screener itself, remember the trigger is the red dots, where the Bollinger Bands are inside the Keltner. The long squeeze is where we get a green dot firing, that we have a positive histogram and positive price action. The short squeeze, right, is a green dot firing where we have negative price action and the negative histogram. All right. All right, James asked a question. Let me do this here for you guys because I wanted to do this before. Is understanding that the Bollinger Bands are calculated on a simple moving average and the Keltners are based on an EMA, if that is accurate, does it make a difference for the squeeze? Again, the squeeze is something that John Carter developed. I think that kind of makes sense, right? You really want a slower, simple, right? Slower moving average to really define that squeezing, right? Where the exponential is a little bit faster, right? So it kind of makes sense that you want to get the slow inside of the fast to give you that squeeze identity, all right? Well, Leo, I don't know the difference between what is the Barchart squeeze and the Squeeze Pro from John Carter. I know he has an updated version. I would guess that you'd have to go to his website to get that answer. Do I use the TTM squeeze in my own investment? What I do is I do look at it in terms of my watch list, and when I'm aware of it, I am using it for a lot of my option strategies. All right. Okay, so let's do this because I have some takeaways for today. And again, if I didn't answer your questions, I apologize. And you send your questions to support@barchart.com, and we'll get those answers for you. So again, when managing risk, remember, think about ATR movements and that EMAs can provide adequate support for you. So takeaway number 1 is that the TTM squeeze may be complicated in its components, but the Barchart template and our investment page make it very simple to read and react, and that traders need only wait for the squeeze to fire. Remember, red dot squeezes on, first green dot is the firing, and ride that histogram wave to profitability. Remember that there's no such thing as a perfect indicator, right? And risk management is always paramount, right? And tools like the histogram and the EMA stackings improve our signal effectiveness. Again, patience, right? That in convergence of our EMA stackings and that positive price correlation with our histogram. And this one I can't reiterate enough, is that when combining higher time frame analysis, traders can rely on the indicator with more confidence. So choosing intraday or daily signals that are in concert with our weekly signal that has already fired, or a supportive histogram at the week level, makes for a more effective TTM squeeze signal. Okay, folks, I hope you guys enjoyed today's session. I know that I have, and hopefully you guys got something from today's session. If you're watching on YouTube, on our YouTube channel, please give us a like or a thumbs up on that one. All right, so again, all of our webinars are archived on our webpage or through our YouTube channel, and there you can see the secret of John Carter's webinar that we're doing today. If you click on that, up to the right hand is where you can download the slides that I showed you for today. Next week, our upcoming webinar, we're going to look at covered calls. And we've done a lot of covered call webinars, but in the last year, we've done a lot of updates to our options pages and option screenings, and certainly covered calls has been one of the ones that has been updated. So I think it's time for us to do an updated covered calls. And I think it really kind of makes sense right now to learn how to trade covered calls, especially in the environment that we're in. You know, we're at all-time highs, and the market's got a lot of nervousness, a little nervous energy, and this could be a good opportunity time for us to start looking at the cover call strategy for options. Okay, I see a lot of great comments and a lot of thank yous. I appreciate all those folks. Until next time, the best of health, manage your risk, and the good of all trading.